My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found in some of the biggest proprietary trading firms and hedge funds in the United States. Today, we're going to talk about the opening range breakout. The opening range breakout was made famous by Toby Crable. It was also a technique that was used by many floor traders for years. And the idea behind the opening range breakout is that every day on the open, there were new large buy orders coming in and new large sell orders coming in from various commercials and institutions. So on the open, there'd be a flurry of trading activity as these large buy and sell orders would trade with each other or would be facilitated by market makers to be able to make sure that both sides were executed. So volume is heavy on the open, but then a period of time after the open, that volume would die down. Those trades and orders would be cleared. And then if you were to have a quiet type of day, well, the market would just go sideways the rest of the day. But if you were to have a trend day, you would have a trend day because one of those parties did not get all their orders done on the open. So maybe we have a hedge fund that's a big buyer and we have a commercial firm that is a big seller. They both have business that they want to do on the open. They would trade with each other. And let's just say the hedge fund wanted to buy 50,000 contracts and the commercial firm wanted to sell 20,000. Well, in those opening minutes, those 20,000 contracts would trade and be cleared. Now, once those are cleared, the hedge fund still has 30,000 contracts left to buy. So they're going to be buying them. And when they need to buy them, where's the market going to go? Where's the price going to go? It's going to go up. So we would set an opening range. There'd be all this trade. And then from this range, the market now would start to break out of the opening range and it would run. Whenever we have a trend day, we usually see the market break out of the opening range and then run into a bigger range, thus creating a trend. Remember, in a normal day, the first standard deviation will contain prices. An average true range will contain prices. But when we have a trend day, we need to get a move that's bigger than an average true range. We need to get a move that's bigger than one standard deviation. So we can use the opening range breakout to track this. Now, a topic for another video I will do is we talk about the idea that every price bar has a high and has a low. And if I know the low is going in, well, then the remainder of the period, the only direction that remains is for the market to go up. So I have used this concept of the opening range breakout and I modified it into my own version. Called an initial balance period, an IBP. And we look for IBP breakouts. Now, IBP breakouts have all kinds of uses. It can be a trading strategy, but it also can be what we call a market environment filter. In a market environment filter, it tells us that the environment is favorable for longs or favorable for shorts. It doesn't necessarily say you need to buy, it doesn't necessarily tell you where you're wrong. It tells you that the environment is favorable. So IBPs are great as a trading strategy and also as an environmental strategy. So today I'm just going to show you quickly what this might look like. So in the equity world, we have what's called the opening print. In the opening print, they gather up all the resting buy orders, all the resting sell orders, all the market orders, and essentially the specialist or the person running that book, they're responsible for matching up those bids and offers. So what you see on the opening print in stocks is you see high volume come through on the opening print. Then after the opening print, for the next few minutes, the market tends to be unstable, kind of flying around. But as those orders get done, it'll settle in to a range. So I'm going to show you is what this might look like. So this is in SPY. And what we're going to see here is I use the first 15 minutes of the day session as my initial balance period, as my IBP. And you can see here, this was on Friday, the 29th. The market gapped coming off of Thanksgiving. And these are 5-minute candles. So these first 3 candles make up the first 15 minutes. That's the IBP. And I want you to notice that after these 3 bars are created, it creates a gray box that gets extended to the right. Now that gray box represents the high of the IBP and the low of the IBP. So now once we've created the IBP, what we're watching for is which way do we move out of the IBP. And you can see right here, we move out up. Okay, this gives us a long signal if we're using it as a trading strategy. And it gives us a market environment filter that's telling us the low for the day is probably in. So very simply, you could see here, we could go long right here, put our stop under the low. And then many days we get this kind of behavior where the market then just spurts and goes higher, 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 all the way into the close. So in this case, we're buying roughly 650, call it, with a stop at 599.35. So risking $1.15, and the market ends up going out at 603.66. So you make 316 on $1.15 a risk. Well, that's almost 3R. And that's a very simple strategy. We use this on multiple time frames all the time. It's simple, it's useful, and I encourage you to check it out. Because after all, what day is today? Yeah, that's right. It's Tuesday. And it's not just any Tuesday, it's Trader Tip Tuesday, where I come to you with tips like today with the IBP that help you take your performance to an elite level. So I will see you next Tuesday.